Describe types of equity indices. Broad-based market indices represent an entire given market. The Wilshire 5000 and the Russell 3000 are market capitalization-weighted indices and represent the US markets. Likewise, the Shanghai Stock Exchange Composite Index is a market cap-weighted index that includes all shares that trade on the Shanghai Stock Exchange. Typically, broad-based market indices cover up to 90% of a given market. Multi-market indices are typically comprised of different countries and represent multiple markets, regions, or economic development groups. There are even whole-world indices. MSCI Barra, an index provider, classifies countries along development status and geographic region, for example. In its indices, countries are separated by regions and include Americas, Europe and Africa, and Asia and the Pacific. It also classifies markets along their economic development status and considers countries that are developed, emerging, or frontier. Some index providers institute a fundamental weight in their multi-market indices. In 1987, MSCI introduced a fundamental weight to its MSCI EAFE index because Japan made up 60% of the index at the time. Country securities are now weighted by market cap, and then countries are weighted by their relative GDPs. After MSCI introduced this fundamental weight, Japan's weight fell to 30% in the index. Sector indices track economic sectors, or industries such as consumer goods, energy, finance, and technology, to name a few. Typically, sector indices are broken up into regional, national, or global basis. Sectors indices are important for investors because they behave differently throughout the business cycle. Investors may wish to overweight certain sectors and underweight others during particular periods throughout the business cycle, due to typical variations in performance. For example, the technology sector may outperform the utilities sector during the expansion phase of a business cycle, while defensive sectors, such as utilities and healthcare, will outperform during the contraction phase. In addition, sector indices are useful for analyzing performance of active managers because they help determine whether managers are better at selecting sectors or better at selecting individual securities. Lastly, sector indices serve as model portfolios for exchange-traded funds and other investment products. Some indices represent stocks based on their market capitalization and classify them as either large cap, mid cap, or small cap. Because there is no universal definition of these categories, index providers often differ on their distinction. Index providers also classify companies as either growth stock or value stocks. Typically, this classification is based on certain valuation and growth ratios, such as price-to-book ratios, price-to-earnings ratios, and dividend yields. Again, there is no universal definition for classifying growth and value. Combining the capitalization and value growth categories, an investor can invest in 6 distinct styles, such as small cap value or large cap growth, as examples. Stocks often migrate between styles as their valuations change over time.